Okay. Hi, everyone. Welcome to Master Key Associates. This is financial management class. Financial management class. So tonight we are going to start the lecture for the new diet, November 2026. And I want to appeal to everyone on this call to be systemic and determined. Yes, FM is not a course that you will jump one topic and move to the next topic. No, it does not work that way. Please. Nobody on this call should repeat this course for anything. It depends on what you do. We have promised to give you the very best you need to succeed. So let me show us now the summary of the syllabus. The summary of the syllabus. The summary of the FM syllabus. Now, the part A is titled Financial Management Functions. Financial Management Functions and Environment. This aspect of the syllabus takes 10%. 10%. That aspect is 10% of the syllabus. Excuse me. Those on call. Take 10%. The next part, working capital management. This take 15%. I am going to send us the copy of the syllabus each tomorrow. See now, investment. Appraiser takes 25%. Takes 25% of the syllabus. Next, the business finance. The business finance takes 20%. E, business evaluation. The business evaluation takes 15%. The last now, The risk management takes 15%. Total $100. So that is the breakdown. Okay, what you have on the board is what we call grid. Grid, the summary of the syllabus. Okay, the summary of the syllabus is called the grid. Exactly. Please, I want to reaffirm our commitment to you to ensuring that you pass all your papers. Say, do not be like that student who will not read his or her book until 2 weeks to exam. Tell me, what can such a student do? These are the categories of students that will be looking for shortcuts, and there is no shortcut. The only shortcut is to attend the class, be taught, and pick your books and read. Even when we give you AOC, the AOC will only work for you with your knowledge of the things you have learned before. Is that clear? Please. ICANN is not a mountain. Yes, and it will never be a mountain. But the ignorance of some students is the reason why they have challenges. So please, let us have a change, okay, of mindset. So these are the components of the FM syllabus. And by God's grace, we are going to cover all. This part one, the financial management functions and environment. This part one, we are going to have it in audio, okay, in audio, where the materials will be shared. So virtually from part B to F involves calculation. However, there is a little calculation too in part A. Yes, in part A. But mainly from part B to part F, you have serious calculation. Calm down, relax your mind. You are a master key associate by God's grace. No shaking, exactly. So let's start this. Tonight, we are going to start right away with one of the fundamental topics. Yeah. Now, remember that the essence of a firm, or the primary objective of a firm, is to maximize the worth or the value of shareholders. Is that clear? We are going to talk more on that under financial management functions and environment. Okay, but we should bear in mind that the objective, the primary objective, which is also called the financial objective of any firm, is to maximize the worth of its shareholders. Now, in order to maximize the worth of the shareholders, the financial manager or the CFO must take certain decisions. We call it functions. Functions, okay, or decisions of the finance manager. The finance manager. Functions or decision. Please send a test, okay, please, okay? Send a test. Functions or decisions of the finance manager. Over there. Functions. Please, your video is on. I will remove you. Yes. Some people are students, but because of their schedule, they cannot join the live class. They only rely on the videos. Please. Now, the finance manager must take 4 key functions. Number 1, investment decision. Okay. 2, dividend decision. 3, let me say, investment, financing, dividend decision. Risk management. These are the functions or the decisions that a financial manager must take if we are going to achieve our objective as a firm. Class, what do you understand by investment decision? Investment decision, okay, has to do with the ability of the finance manager to identify or to look for any profitable available investment. Is that clear? So this investment could be a short term or a long term. The long term investment is what you call investment appraiser, okay, or the capital project. Is that clear? So the short term could be the treasury bills and others. But the finance manager must be able to identify any profitable available investment opportunities. But mostly, we focus here on the long-term investment. Okay, so that is why in your syllabus, there is a topic called investment appraiser. Is that clear? Now, by the time the finance manager has been able to identify a particular available investment, okay, what is the next thing? Such investment will be appraised, okay, will be appraised. That is called investment appraiser. And what is the essence of investment appraiser? The essence of investment appraiser is to determine the cost, okay, of the investment and the associated benefit or returns and risk. So in order to appraise the investment appraiser techniques will be applied. Okay, like you all know, your accounting rate of return, okay, your payback period, your internal rate of return, okay, your net present value. These are the techniques you will be applying at this level of your financial management. So we use the investment appraiser techniques, okay, to appraise that particular investment. Exactly. Now, after the appraiser, okay, we want to know, is this investment profitable? Okay, is this investment what profitable? Out there, don't forget, we want to maximize the wealth of the shareholders. So, is this investment profitable? Out there, so this will be determined from the appraiser. Now, by the time we certify that come, this investment is profitable, then the management would approve it. So we are going to embark on that investment. After that, there is another challenge. The challenge is, how do we finance this profitable investment? The finance manager too, we have to think, how can we source for money? Okay, how can we source for money? That brings us to financing decision. So the financing decision, okay, is the decision on how to source for fund, exactly, from every means, so that we can finance the profitable investment. And in finance, there are three sources of fund: short term, medium term, and long term. So these are the three sources of available funds: short term, medium term, and long term. Remember that the fund you are going to raise, either you are going to issue shares, okay, to raise money, or you are going to issue debt instruments to raise money. For any fund you raise, you are going to incur a cost, and that cost is what you call the cost of capital. Out there, because nobody would give you his or her money free of charge. No, they will expect something in returns. Exactly. So the finance manager must be very, very careful, okay, to weigh the cost associated with a particular fund they are raising. Why? If the cost of capital is too high, it would have effect on the value of the firm. So that is that. By the time the fund is raised, then the investment is now financed. Exactly. Now, at the end of the whole thing, the returns from the investment, the profit from the investment, okay, would be decided upon how it should be shared. That brings us to dividend decision policy. Okay, I say dividend policy decision. Now, the dividend policy decision is the decision that has to do with how much or what percentage of the returns of the profit we should give out to the shareholders as dividend. Should we give the shareholders 50% of the returns as dividend while we keep 50%, or should we give them all the 100% while we have zero retained earnings? Or should we even not give them dividend at all for particular years, so that the returns can be retained, and now use that retained earnings to finance further projects? All these decisions is called the dividend policy decision. Out there, the dividend policy decision, excuse me, the dividend policy decisions. Out there. Now, in finance, we do it estimate, okay? Estimate, out there, estimate. Now, the income to be received or the expenses to be paid in the future, right? Now, if the income we are to receive or the payment we are to make in the future is determined by exchange rate, then there is another challenge of risk, because the exchange rate you are going to use in the future could either work against you as a company or could favor you. Therefore, we have to work to manage the risk. That is called risk management. Is that clear? Now, in brief, these are the summary, okay, summary of everything we shall be talking about in the financial management. Is that clear? So tonight, we are going to start with a topic called the cost of capital. Okay, the cost of capital. The cost of capital. Excuse me. Okay. Cost of capital. Class, remember that earlier we look at the functions or the decisions of the finance manager. And one of it is what the financing decision. That is how the company, okay, raises finance money from different sources. And I said that for every money you raise as an organization, you are going to incur a cost. Exactly. So we need to determine the total cost. So that cost you are incurring as company to raise that money is called the cost of capital. Now, what is the meaning of cost of capital? Out there, the cost of capital, this is the minimum, okay, rate of return required by the capital providers, by the capital providers. Okay. The minimum rate of return that is required by the capital providers, that is, those that lend you money, okay, what they expect from you. Is that clear? For instance, now, if I go to bank that, please, I need loan, okay, of 20 million to finance a project. Of course, you don't expect the bank to give you that loan for free of charge. The bank will charge interest. The interest to you as a company is the cost of that loan. Exactly. So it's the cost of capital. While the interest to the bank is return. You can see now. So it's the minimum rate of return required by the capital providers. Also, it could be the minimum rate of return a firm the minimum rate of return, okay, that a firm must earn from its investment. Yes. Okay. So you can also say the minimum rate of return that a firm must earn from its investment. See now, if you have gone to the bank okay, to take a bank loan, let's see, bank loan, right? And the interest, okay, you are charged is 20%. Exactly. And the money you have taken from the bank, you want to invest it on a project. And it means that if I must invest that money on a project, so the investment or the project must give me a return that is at least equal, okay, to the rate, to the interest I am going to pay. Is that correct? So the minimum rate of return that a firm must earn from its investment. Is that correct? So that is that. Now, you should also know that the cost of capital of a firm depends on the nature of the firm. Yes, the cost of capital of a particular firm depends on the nature of the firm. That is, a firm or a company, okay, a company could be geared and ungeared. Class. A company could be geared and ungeared. Is that clear? Now, what do you understand by geared? When you say a company is geared, it means that such company is financed, okay, both with equity and debt. With equity and what? And debt. What is equity? The shareholders' investment. It's the ordinary shareholders' fund and debt. So when a company is financed with equity and debt, such a company is a geared company. Is that clear? It's a geared company. Now, when a company is financed only with equity without debt, such is called ungeared. Is that clear? Ungeared. So that is why the total cost of capital of a company depends on the nature or the capital structure of the company. For a geared company, the cost of capital will be different from ungeared. Is that clear? So, thus, the cost of capital of a geared company is called WACC, the weighted average cost of capital. WACC, the weighted average cost of capital. Why? That of an ungeared company is called the cost of equity. The cost of equity. So, see now, the cost of equity. Now you understand that the total cost of capital, okay, of a company is determined by the capital structure. Please, Matthew, please off your video. I don't want to talk about this tonight. MJ. So the total cost of capital of a company, okay, depends on the nature of the firm or the capital structure. Is that clear? Now, I want you to know that in finance, the cost of capital of company A cannot be applied to company B. Why? Due to their nature. Okay, due to their nature. Is that clear? And you should also note that what? That every cost of capital must compensate for risk. Yes. The cost of capital of a firm must compensate for business and financial risk. So, class, the cost of capital of a firm, who is this person now? Hey, Matthew Energy. I don't know what you are doing here now. You have doubled this video. Yes. God. So the cost of capital, okay, of a firm must compensate for the business and financial risk. Is that clear? The business and financial risk. We are going to come to risk later in full. So, next now, elements of the cost of capital. Most of us don't even have an idea of this. Elements of the cost of capital. Elements of the cost of capital. Now, there is what we call element of the cost of capital. And I am going to show us now a scenario, okay, a scenario for better understanding. Element of cost of capital. Element of cost of capital. Now, when you say elements of a thing are those things that make up that thing, right? Let's say, if you approach a bank, okay, that come, I want a loan, okay, I want a loan, right? I want a loan of how much? 500 million. You hear me? The bank will say that our average interest, okay, normal interest without any risk attached is 10%. Are we there? Our normal interest without risk attached is 10%. However, because of the project or the business you want to use the money for, okay, we are going to take a risk as a bank to give you that money. Therefore, you are going to also compensate us for the risk, okay? That is called business risk premium. Let's say 2%. Okay? as if that is all. By the time the bank check your financial statement, and the bank will see that, oh, this company is geared. That is, you are even having debts with other finance company to settle. The bank will say, you are also having debts. It means you are geared already. So you are also going to expose us to another risk, which is called financial risk. For these two, you are going to compensate us, let's say 3%. If you now add together, this is called the 15%. So it means this is the total interest that the bank will charge on the loan that is given to you. Now you can see the component of this, the normal interest without risk, the risk-free rate. 2, compensation for business risk. 3, compensation for financial risk. So everything is 15%. So it means this is the interest that the bank will charge you. So that is how it's being done. Okay. So now, what are the elements of cost of capital? The element of cost of capital are: number 1, the risk-free rate of what? Return. Okay, the what? The risk-free rate of return is the normal interest rate without any risk. The normal interest rate without any risk. 2, say premium for business risk. Yes, that is what? Compensation, okay? Compensation for business risk. Compensation for business risk. Premium. The next, premium for financial risk. You know what? Another compensation for financial risk. So therefore now, okay, you have the risk-free rate of return plus the premium for business risk plus what? The financial risk. These are the 3 elements, okay, of the cost of capital. That percentage you see, okay, these are the elements of that percentage. Please bear in mind that when we define the meaning of cost of capital, we said is the minimum rate of return. That is the keyword, rate. Which means what? It must be in percentage. It must be expressed in percentage. That is the implication of that word, minimum rate of return. Is that clear? Now, my people, I want you to please pay attention here. You know, I said earlier that the total cost of capital of a firm or a company depends on the nature, okay, that is the capital structure of that company. For a geared company, okay, the cost of capital is WACC, the weighted average cost of capital. And for ungeared, the cost of capital is equity, the cost of equity. I want you to understand that in financial management, our focus of cost of capital is for the geared company, okay? For the geared company, a company that is financed through many means. So let's see now. The summary now, summary of capital of a what? Of a geared company. Yes, the summary of what? Of capital of a geared company. That is, what are the various sources of finance that is available to a geared company? Out there. So here we have the source of finance. The source of finance. Okay. Here you have returns. Returns. Returns to provider of capital. Okay, right? Returns to what? To the providers of capital. Last now, the cost to company. Is that clear? Remember, that word, cost of capital, it has two ways. It is a return to some people, Abi, to the capital provider. Why if it's a cost to the company that borrows that money? So one is equity share. Equity share. Okay, equity share, that is, a company can have equity share, your ordinary share. Is that clear? Now, what is the returns that the company gives to the shareholder? It's called dividend. Dividend. Okay, out there, it's called dividend. Now, the dividend is the returns to the shareholders, but to the company is called cost of equity. It's called cost of what? Equity. Out there. Next now, we can also raise money from debt. Debt capital. Debt capital. Class, when you say debt, okay, we are talking of a traded debt. A debt that can be bought and be sold in the capital market. Out there. Yes. A debt that is being traded. So this debt capital, okay, can be subdivided into three. Out there. It could be, let's say, redeemable. You see, I am trying to give you the picture of everything you are going to do under this topic. Redeemable, okay, debt. Two, irredeemable. Debt. Three, convertible debt. Now, whether redeemable, irredeemable, or convertible, the cost of cap, okay, the returns, okay, the returns to the providers of this debt capital, okay, is what is called interest. They all collect interest. Interest out there. So they all collect interest. And this interest now to the company is called cost of what? Debt. Abi, you say cost of debt. cost of debt, KD, so is KE. Okay, cost of what? Redeemable debt. This one is also the cost of irredeemable debt, the cost of debt too. Anyway, this one too. So the cost of convertible debt, cost of debt too. So that is okay. That for debt capital. Next now is preference share. Number 3. Preference share. A company can also raise money by issuing what? Preference share. Now, what is the returns to the preference shareholder? It's called preference. Okay. That's a preference what? Dividend. Out there. Okay, it's called what? It's called preference dividend. Yeah, because the preference shareholder collects what? Preference dividend. So what is the cost to the company? It's called cost of preference share. Cost of preference share, KP. Last now, the company can also raise money through bank loan. Yes, bank loan. Now, what is the return to the bank loan giver? It's also called interest. Interest. Okay. Now, what is the cost of the interest to company? It's also called cost of debt, Abby. Cost of debt. Okay, cost of debt or bank loan. Yeah, cost of debt too. How there? Cost of debt, okay. Or let's say bank loan, whichever. Of debt or bank loan. So class, this, okay, are the summary of the total capital structure of a geared company. Okay, these are the various ways, okay, by which what a geared company can raise money from. So in FM, our cost of capital shall be focused on a geared company, which is called WACC, the weighted average cost of capital. And in order to calculate WACC, it means we are going to calculate the cost of each finance, the cost of equity, and the market value of shares, to the cost of debt, and the market value of debt, 3, the cost of preference share, and the market value of preference share, 4, the cost of bank loan. A bank loan does not have a market value because bank loan is not a traded debt, okay? It's over the counter. You walk to the bank and negotiate. But other debt capital like this, they are traded debt, okay? So tonight, let's start now with the cost of equity. With the cost of equity. Cost of equity. This is the sign. Cost of equity. Remember that cost of capital is the minimum rate of return or minimum required rate of return by the capital provider. And we said that a company can raise finance through various means. And one is what is equity share. And the cost of equity to the cost of the equity shares, okay, to the company is called the cost of equity. Now, what is the meaning of cost of equity? This is the minimum rate of return that is required by the equity capital providers. Okay, this is the minimum rate of return required by equity capital providers. Are we there? Yes. That is for those that invest in the ordinary shares of the company, the shareholders. So the cost of equity is the minimum rate of return required by the equity capital providers. That is what the ordinary shareholders, okay? The ordinary shareholders. The ordinary shareholders. Now, the cost of equity is represented by KE, the cost of equity out there. Now, how do we calculate this cost of equity? That will be methods of calculating cost of equity. According to your syllabus, okay, skills level, you have to know, number one, a dividend valuation. Dividend valuation model. DVM. Okay. DVM. 2 or B, capital asset pricing model. CAPM. Capital. The third one, C, Modigliani. Modigliani and Miller. Class, these are the three methods you are going to learn. But we are going to look at this, Modigliani and Miller, when we get to capital structure. Okay, capital structure. When we get there, okay, by God's grace, we are going to look at this. Now, So dividend valuation model, capital asset pricing model, okay, and Modigliani and Miller. So these are the three methods you are going to consider. So let's start now. Dividend valuation model, okay, or method. Dividend valuation model or method as a method of calculating the cost of equity. Dividend valuation model. Remember, this is one of the methods of calculating the cost of equity because your question can test you on the DVM or capital asset pricing model or Modigliani and Miller. Now, what is dividend valuation model? Remember, it is one of the methods of calculating the cost of equity. Now, under dividend valuation model, okay, the cost of equity of the company is calculated on the basis of the dividend that is paid by the company to the shareholders. The description is self-explanatory. Dividend, okay? So it means under this model or method, the cost of equity is calculated on the basis or on the amount of dividend that the company paid to the shareholder, okay? Under this model, the cost of equity is calculated on the basis of dividend paid by the company to the shareholders. So that is what you be what making use of dividend, okay, in this case. Now, your syllabus also made it clear that under the dividend valuation model, you are supposed to know the assumption, okay? Yes, the assumptions. Now, assumptions of dividend valuation model. Remember that the key word is that under the dividend valuation model, the cost of equity of a firm, a company, is calculated on the basis of the dividend paid to the shareholders. However, a number of assumptions, okay, will play. These are also contained in the syllabus. So you might be asked, what are the assumptions of dividend valuation model? One, or I, dividend payment, okay, is constant. Meaning what? Dividend must be paid. Must be paid. Two, it does not consider, okay, capital gains on share. Yes, this method does not consider the capital gains on share because when we talk about the wealth of the shareholders, the wealth of the shareholder is maximized through dividend and the capital gains on their share and others. We are coming there. Okay. Third now, this method is only used by a dividend paying company. Yes, paying company. It means if a company is not a dividend paying company, they cannot use this method. So these are some of the assumptions. Is that clear? So remember that dividend valuation model is one of the methods of calculating the cost of equity. And we said under this model, the cost of equity is calculated on the basis of the dividend paid by the company to its shareholders. However, this method is supported by a number of assumptions. Number one, dividend payment is constant. Number two, it does not consider capital gains on share. Number three, this method is only used by a dividend paying company. Now, how do we calculate now the cost of equity under dividend valuation model? Please be with me here. Okay. We are going to the main domain now. Remember, we are on the dividend valuation model. Class, please. I told you, FM, okay, is one of the simplest subjects in skills level. Yes, and the challenge is that most students are not systemic. Yes, what do I mean? They jump one thing and move to others. It does not work that way. There are things that you must understand. It's like you are trying to construct a three-story building. You are not going to start from the top. No, you start from the foundation. Yes, because the foundation determines the durability or how long that structure will stay. So cost of capital is a must. You cannot escape it. I know it has different aspects, but you can learn it and still understand it. So please pay attention. Now, remember, we are on the cost of equity, right? And we said that the cost of equity can be calculated in three ways: dividend valuation model, capital asset pricing model, Monteglani and Miller. Oh. Now, and we are on the dividend valuation model. That is, under this model, the cost of equity is calculated on the basis of the dividend paid by the company. And we look at the basic assumption. Now, how do we calculate the cost of equity using dividend valuation model? Are we there? Now, hey, see, when out there, when what dividend is not growing, or let's say when there is no good, Abi, when there is no good, when there is no growth in dividend, class. That is, the dividend of the company might be constant. I mean, that is constant. Okay, it's not growing. The one they pay in 2016 is what they will pay in 17, 18, 19. Is that clear? When there is no growth in dividend. Therefore, the cost of equity here, is DO over the market value of equity as div. Everything you get here times 100 over there. Now, B, when there is growth in dividend, when there is growth in dividend, meaning what? Dividend is not constant, it's growing. That is, the one you pay in 2020 is not the one you will pay in 2001. It is growing every year at a particular rate. Okay, so in that case, the cost of equity is DO 1 plus my G over my market value, my SD, plus the growth rate, whatever you get, into 100. Okay. Now, these are the two ways. Now, how do you know? See, how do you know which of these two you are to use for the cost of equity when you are asked to use dividend valuation model? Come on, it's very simple. You need to know. Question: is my dividend growing? If yes, this. Is it not growing? Is it constant? If yes, this. Exactly. So, definitions of variables. Okay, we use of variables. My KE is the cost of what? Equity. My DO, okay, is a current annual dividend. Okay, current what? Current year dividend. Let's say current year dividend. Okay, out there, dividend. Please, are you with me here? So my DO bracket 1 plus G means next year dividend. My G is the growth rate of what? Of the dividend. The rate at which our dividend is growing every year. That's it. And then the MVE. Market value of share. Of share after the payment of, okay, let's say market value, okay, of share, okay, excluding, anyway, let me see, excluding the current dividend. Plus, these are the definitions, okay, of the variables. Exactly. So now there is one thing here called the growth rate, the G, because the dividend can be growing or cannot grow. That is just what remain constant. So let's go in now. Sonny, please off your video, please. So let's go in our class. How do we determine the growth rate? Yes, remember, there is growth rate. Because in a standard question, the examiner will not give us the growth rate. It is our responsibility to determine the growth rate by ourselves. So it means after getting the growth rate, you will now come back again to use that growth rate to find the cost of equity. You can see it is systemic. Now, determination of growth rate. In dividend. The G, Abi, is the symbol. How do we determine the growth rate? Now, what is growth rate? This is the rate, okay, at which the current year dividend is expected to grow in the future. Okay, the growth rate is the rate at which the current year dividend is expected to grow in the future. And there are two methods here, okay? Methods. Okay? Methods. Let's say method one, dividend. No, let's say Gordon growth. Gordon growth model. Gordon growth model. Okay. Gordon growth model. Two, dividend growth model. Dividend growth model, or the historical pattern model. Class, these are the two methods of estimating the growth rate. So the first one now, Gordon growth model. Now, class, under this Gordon growth model, the growth rate, okay, is calculated on the basis of the retained earnings and profit on investment. We believe that, okay, if we retain part of our earnings, okay, and reinvest it, therefore we are going to make more profit in the future, and the more the profit, the more dividend we are going to give. So that is the basis of that. So it is calculated on the basis of the retained earnings and returns on investment. So under this model, the growth rate is R times B. R times B. What is your R? The R is what? Is the return on investment. Is that clear? The return on investment, the ROI or the ROS, the return on investment. And how do you find that? That is your part, profit after tax over the opening equity. Okay, over the opening equity times 100. So you have a percentage here. That is R. So what is the B? B is a percentage of current earnings retained. Percentage of your current earnings retained. What are they saying? When you have your earnings, your earnings is part, your profit after tax. From that earnings, you pay dividend. And the one you have left is called retained earnings. Let's say retained earnings is part, let's what, dividend. So B is saying the percentage of the current earnings retained. So simply put, is saying retained earnings, okay, retained earnings over part. Okay, saying what? Your B is retained earnings over what? Over part times 100. So therefore your G equals to R times B. That is how you find your growth rate under the Gordon growth model. Okay, now let me take question from here. Yes, one after the other, please. Okay, or wait, let's continue first. Let me give you the second one. Now, this is okay, the Gordon growth model. Next, now, the dividend growth model. Dividend growth model. Dividend growth model or the historical pattern model. Dividend growth model or the historical pattern model. Class. Under dividend growth model, the growth rate in dividend is determined, okay, by making use, the previous dividend information of the company. You see, now in the exam question, how do you determine which of these methods to use? If you are given information about the okay, about the company's past dividend, it means you are going to use the dividend growth model, okay, which is also known as historical pattern model. So the growth rate is latest dividend over earliest dividend, okay, then whatever you have here, -1. Over there. So that is what dividend growth model or historical pattern model, where the N is the number of years, the LD the latest dividend, that is what the current one, the ED, the earliest, okay, the earliest dividend. You know what? The first dividend, okay, in the question is the ED. So let's take a look now at questions, okay, to see how we can find the cost of equity using dividend valuation model. Please open with me to your material, okay, to your material. Sharp, sharp. Okay, now I will look at now question one. Question one. Question one. Are we there, class? Question one. Okay, question one. Please, let's go through it. S, Y, Z. S, Y, Z. Are we there? Okay, S, Y, Z. Okay. Question one. S, Y, Z. So let's go now. S, Y, Z limited. Okay. We can go. Now, a company's share, hello, has a current market value of 13 naira. Okay, of 13 naira. The market share price per unit now. The most recent dividend has just been paid. It means what? The company has paid the current dividend. And what does that mean? It means that the market share price is still because that is the price of the share after the dividend has been paid. Are we clear now? So that 13 naira is still. Okay. The dividend just paid was 1 naira 50 kobo per share. Estimate now the cost of equity, assuming annual dividend is expected to remain constant. That is, when there is no growth in dividend. B, annual dividend is expected to grow by 4% each year when there is growth in dividend. So we are working on the two bases now. Okay, let's say A, when there is no growth in dividend. So our cost of equity, is the current dividend by the market value as div, right? What you have times 100. So class, in this case now, what is our DO? Our DO is the current what dividend. Are we? The current dividend. And that is how much? 1.5 naira. Our MVE is the market value as dividend. Meaning what? The market value excluding dividend. Okay. Now, how do you know if the market share price is SDIV? When you hear that the dividend has been paid, so it means that the market share price is SDIV. If you hear things like the dividend is proposed or is planned to be paid, it means that the market share price is cum div. So what are you going to do? You are going to take away the dividend from that share price so that you can have your SDIV. So here is what is 13 naira XD out there. So our cost of equity now is 1.5 over what? 13 times 100. Is that clear? So this will give us what? 11.5%. 11.5%. That is the cost of equity of the company, okay, when dividend is constant. B, when there is growth in dividend, what is the growth rate? The growth rate is 4%. Now, in this case, the examiner has given us the growth rate. That is good. So, the cost of equity now here, the DO into bracket 1G over the market value SDIV plus the growth rate into out there. Now the G here is 4%. You express in what? In decimal. That will be 0.04. Okay. You express your growth rate in decimal 0.04. Of course, my DO is given as 1.5, 1.5 bracket 1 plus 0.04, the G. My market value is SDIV already, 13 plus G again is 0.04. So times 100. So 1.5 times, okay, let's say here, let's say 1.5 1 plus 0.04, that will be 1.04 over there over 13 plus 0.04 100. Okay, 100 over there. So 1.5 times 1.04 over there. 1.5 times 1.04. Okay. So what you get, you divide by what? By 13. By 13, right? By 13. By 13. My calculator. Okay, now 1.5 1.5 times 1.5 times 1.04. Okay, here I have 1.56. Okay, 1.56. So divide 1.56 by 13. Here I have is 0.12. So now is 0.12 plus 0.04 now. Is that clear? Okay, times 100. Out there. So 0.12 plus 0.04, that is 0.16. So is 0.16 times 100. We have 16%. 16%. That is the cost of equity. Okay, when there is growth in dividend. That is the cost of equity when there is growth in dividend. Okay, when there is growth in dividend. So, any question? So, class now, any question? Yes, yes. You are now unmuted. Okay, any question? Hello, please, one after the other. When somebody is asking question, okay, be patient. I will call you by name. Okay. Danjuma, please go ahead.
Okay, sir. Good evening, sir.
Danjuma.
So, yes, sir. Can you hear me, sir?
Sir? Yes, sir. Yes, sir.
Yes, sir. Sorry, sir. I need a link. You should resend a link to the platform. My password want to off so that I can use my laptop, sir.
No, sir. It's there, okay, already. Out there. The
I
link is
open my
there.
laptop. It's not there. Can you help me with it again? Sorry,
Okay,
sir.
okay.
Thank you, sir.
Okay. Oh, yeah. Please, next person. Yes. Just raise your hand and I will call you. Okay, so it's like there is no question. Okay. Now, let's look at now. Okay. Jennifer, please. See, Jennifer, type your question, okay? You are having a bad network, okay? Thank you. Yeah. Okay, so let's go now, okay, to look at how to estimate the growth rate. So look at now with me, question 7. Okay, question number 7. Okay, question number 7. That question involves the estimation of growth rate. Question number 7. Let's go through it. Question number 7. Okay. Question 7. Now let's know. Seven. Say, okay, Acon, right? It's Acon Limited. Acon Limited. Out there. Now, Acon Limited asks 10 million 1 naira ordinary shares. Okay? 10 million 1 naira ordinary shares. Details of the company's dividend per share over the most recent 4 years are as follows. You are from 2022 to 2019, and the dividend paid in those years. The current market price is 2 naira 35 kobo. A dividend of 30 kobo per share is expected, see now, is what is expected to be paid shortly. What does this mean? It means our market share price is still in cum div, not SD. So you are going to remove the current dividend, okay, from the 2 naira 35 kobo to get the market share price as div. Required. A, estimate the growth rate. B, what is the company cost of capital? This is the cost of equity. Now, let's say the growth rate class. You know, there are 2 methods of estimating your growth rate, Abi. 2 methods of estimating your growth rate. The Gordon growth model and the dividend growth model or historical pattern model. And I told you what you are going to see in the question, okay, that will help you to determine which of the methods you have to use. Now, let somebody now tell us which of the 2 methods of the growth rate are we going to use here? Yes, one person tell us.
Historical.
Thank you. Thank you. Thank you. Historical pattern. Okay. Why? Because they give you information about the company past dividend. That's all. The examiner will never tell you use Gordon, use dividend growth or historical. No. From what you have as information, you know, I am using this. So our growth rate is latest dividend over the earliest dividend. Okay. Now, the number of years there, the N is the number of years, is what is 4 years. Calm down. Calm down. If you check the table, you have what 2022, Abi, the latest year. You should know this. 2019 is what is the earliest year. Now, if you count now together, 2019, 2020, 21, 22, making 4 years. If they ask you, how old are you? You are going to include your current year, right? Okay. So that is 4. The N is 4. The latest dividend paid there is what is 30 kobo. Okay. It's 30 kobo, 0.3. The earliest dividend is the one in 2019, 26 kobo. Okay. So therefore, my growth rate, please watch me carefully. You are going to get this technique, okay, in a simple way. Now, my N is 4, 1. What is my LD? Is 0.3 over 0.26. 4 minus 1, I have what? 3 is 0.3 over 0.26, okay? Now, class, if I show you the mathematical way here, most of us will get lost. Please, just watch me. Just watch me. Equals to, now, my 3, say, is 0.3, divide 0.3 by 0.26, is 0.3, 0.3 by, please, okay, please, just watch me, okay? This 1.15. Yeah, I have 1.15. My 1. Follow me. Remember, okay, that this my 3 root, okay, could be 1.15, okay, well, 1 over 3. 1 over 3. Now, my 1.15 could be 1 over 3, right? Your minus 1 still stands. They divide 1 by 3. Here you have 1.15. My 1 by 3, 1 by 3, it gives me 0.33. Okay, is 0.33. My 1 still stand. With this now, it is now easier. So you press 1.15, okay, in your calculator, okay, raised to power is 0.33. Over there. 1.15 raised to power is 0.33. Yeah, I have 1.047. 1.047 equals to 1.047 minus the same 1. Now, 1.047, okay, minus 1. I have 0.047. 0.047. I have 0.047. Okay, class? How there? 0.047. So then take it to what? To percentage now. 100 at the 4.7. Class, do we get that clear? Hello, class? Okay, thank you. So this is what? My growth rate. So I know my growth rate now. Then B, I can go and find what now? My cost of equity. Okay, my cost of equity. B, cost of equity, that will be my KE, since there is growth, 1 plus G over the market value SD plus G times 100. Recall that you should always express your growth rate in decimal. So my G now, okay, can be what? Then 4.7 will be, say 4.7 decimal, you divide by 100, okay? I have 0.047. I have 0.047. So what is my DO? My DO is my dividend. It is 30 kobo. Now, the market value is in cum div. How do I know? From the question, it is clear that what? The current 30 kobo dividend is expected to be paid. So it means the market share price is in cum div. So you have to convert to X div. Okay, S div. You have to convert to S div. So what are you going to do? You say the market value S, okay, div. The market value S div equals to the what? Cum. Say the market value cum div. Okay, cum div. But let me do it here. Say the market value, okay, X div equals to the market value cum div, okay, cum div less dividend. Less dividend. Okay, now class, less dividend. So is what is we have 2 naira 35 kobo, 2.35 the market value. Then less what 0.3 the latest dividend. Here you have 2.08. So we have now what converted now, okay, the market value cum div to S div. What else now? We can now find our cost of equity. So my cost of equity, my DO is 0.3. My 1 plus the growth rate, okay, we calculated is 0.047 over the market value SD 2.08 plus the growth rate is 0.047, into bracket times 100. Are we the class? Times 100. Okay. So you do it one at a time. Okay. My 0.3D, I have 1.047, right?
Sorry to interrupt you, sir. Sorry to interrupt you. 2.35 minus 0.3 is 2.05.
Okay, thank you. Thank you. 2.05, correct. 2.05, thank you. Now, here we have, okay, there is 0.3, right? Say 1.047 over 2.05 plus your growth rate is 0.047. So, whatever you get, okay, you are what? Taking to percentage. from the definition, the minimum rate. Okay, so 0.3 times 1.047. 0.3 times 1.047. Here I have 0.3141 over 2.05, okay, plus the growth rate 0.047. Are we there? So divide 0.3141 by 2.05. Here I have 0.1, 5. 0.15. Then plus 0.047 plus 0.047. That will be 0.20, okay? 0.2002. Then take it to 100%, okay? As you know, to 100%. Therefore, the cost of equity is 0.2002 times 100. Here you have what now? 20%. That is the cost of equity. Is that clear? You can say. So this is what you see in the exam. When the growth rate is not given to you, so you are expected, okay, to determine it by yourself. And the question is, how do I know which of the growth rate method to use? That is why I keep laying emphasis on systemic, okay? It's procedural. Yes. So let us take it from the foundation, one after the other. Then by the time we get to work, we are going to treat a complete question, and I can pass question, the complete one. But we cannot treat work until you have gone through this. So this is where we are going to stop. Question, please. Yes, question. Yes, yes. Class, any question?
Okay. Hello, sir.
Hello, sir.
Yeah.
Please, if you are not asking question. Okay, sir.
Honestly, I'm not telling the truth from beginning to end of this calculation. Okay. I have not, unless when I go back and look at this. How about number 7? Look at it again. I have not really understood. Now?
You are not.
All right, let me keep my question like this. I will go back to the video.
Okay, better. Okay, sir. No, see, you know what? The class, okay, still continues. We are not done yet. Are we there? Okay, we are not done yet. So this is just the first class. Okay.
Hello, sir.
First class. Yes, sir.
Hello.
Yes, sir. Go ahead, sir.
Please, when we are calculating the growth rate, the ED, the 0.26, I don't know how we get that.
Is 0. Yes, you know, from the question, right? Let's check. Okay.
Under definition of terms, we have ED.
Yes. Now, they are saying is in kobo. Okay, see now. DPS. Take. DPS is what? Dividend per share is in kobo. So, and then what we have there is 26 naira out there. So, sorry, what we have there is what? 26 kobo, right? Aha. And that is what? 0.26. Are you there? Is in kobo. So that is 0.26. Or how are you going to show it the kobo? When you say 26 kobo, okay, it is what is 0.26. So I have to what? Divide by 100 so that it can be in kobo. Are you clear? Okay, thank you very much. Is that all? Class, again, any question? Don't worry, okay? You will watch the video for better understanding. Exactly. Okay, yes, good evening.
Sir, I have a question. I've been keeping the question since. How are we going to identify, like, if we are giving exam questions, just like the first question you saw, and this second question is confusing. It's really confusing to me. I don't really get, especially this second calculation and the formulas too.
No,
So how are we going to identify each question and how to solve it?
See, your questions are not clear. Okay. Now, are you saying how to calculate the cost of equity or how to identify which method of the growth formula you are to use, or everything?
So how to identify which formula to use?
Okay, thank you. It's simple. It's simple. Now, if you are asked to calculate the cost of equity, okay, right, under the dividend valuation model, because you will know in the question, because there is dividend there. Now, in that same question, you will also know if there is growth in dividend or not. And if there is no growth, okay, you know the formula for the cost of equity, right? And when there is growth. Now, the challenge that you have should be, how will I determine the method of the growth rate? Abi? And it's very clear. The method of the growth rate you are going to use, okay, will be determined by the question. We have the Gordon growth model and the dividend growth model, which is also known as the historical pattern. I said under the Gordon growth model, okay, they won't give you information about the past dividend. But in that question, you will be told that what there is growth rate in dividend, but you will not see information about the past dividend. Also, how would you know if you are to use the dividend growth model or the historical pattern model? They will give you information about the past dividend. For instance, they may say the company paid 20 kobo dividend 4 years ago. Out there, it means what? You are to use historical pattern model, or they give you a table, a list of dividend paid over the years. I don't know if you are clear now. Hello?
I'm with you, sir. Yes, I'm with you, sir. I'm listening to you. I'm going to the questions.
You know what? I want you to watch this video carefully, okay? It will address all your questions. That is why I won't rush you, okay? Now, in the next class now, on Saturday, by God's grace, we are going to see, okay, the Gordon growth model, okay? Then the cost of equity. After then, we go to the capital asset pricing model. Because when you hear WACC is like a building, and the building is built from the scratch, a step after the other. And these are the things you are going to use, okay, in attacking WACC in a full question. Exactly. So I will post the video, okay, tonight by God's grace. Let us watch the video, okay? So you will have better understanding. Are you clear?
Alexa, one more
Thank
thing.
you
Are you
very
going to
much.
have a material?
Okay.
Are you going to have a material where to solve something?
Sir?
I'm asking, are you going to have a material? Are you going to have a material of prop questions?
No. You see, come. Let me tell you people, you see, whatever I give you here, okay, is a perfect guide. FN is a new course, and by God's grace, I'm the lead tutor of SFN. Yes. So don't entangle yourselves. Whatever I give you here, okay, as calculation, plus those simple things you have in your icon pack, you are okay. You are okay. Exactly. You are okay. Many would have done well, but the fear of questions, they pick material A, material B at a point they got confused. Exactly. Please just follow me systematically, and let us build the knowledge together. Okay. So thank you very much. So till tomorrow by God's grace.
Sir. Thank you, sir.
Yeah, welcome.
Thank you, sir.
Yeah, welcome.
Thank you very
Thank you
much.
very much, sir.
Stop now. Very good.